And welcome everybody to another episode of Smart Money Circle. I'm your host, Adam Sarhan. With me today is Ryan Krueger, co-founder and CEO of Kruger and Catalano, an RIA based in Houston, Texas, with approximately 400 million in assets under management. Ryan, thank you very much for being on the show.
It's my pleasure.
So, Ryan, can you start with your story? Let us know how you got started in this business.
Sure. I have not known any other business, and while I don't necessarily recommend this to anybody else, I don't even have a resume, and that is not for any spectacular wizard reason. It was because I was declined an interview when I came out of school, knowing that this is the path I wanted to go down ever since I was a kid, Adam. I worked every summer since I was a little kid, and at some point, probably about 12 or 13, I realized I had to figure out what to do with these couple measly dollars. And so the world of investing through books at first and just a voracious appetite to learn started there. And I knew this is what I wanted to do. There was only one problem, that the big Wall Street firm that I wanted to work for said, we don't interview kids your age. And I was under the naive illusion that everybody that worked at these firms wanted to figure out the markets and manage money. But what I picked up pretty quickly in the non-interview rejection was, you have no network whatsoever, and this is largely a sales job, which I understood and worked around, and then came back and asked if he wouldn't interview me, would he at least talk to me if I stopped by and visited. And through a very hard-charging negotiation with zero leverage later, I ended up in the mailroom.
Oh, wow.
And I started, I believe, the princely sum of $21,000 a year. And 10 years later, I graduated Wall Street as a senior portfolio manager. So it has been an incredible journey.
Wow. So how old were you when you first applied?
So right out of University of Texas at Austin, I don't recommend this either. I started the next, or 2 weeks later, since the first week was the non-interview, what am I going to do with this Sears suit that I put, I think, all of my money into, to writing what I call the Hail Mary letter and earning a visit, and then being offered to start by putting these giant tanks of printer cartridge dust that somehow became ink. I'm not familiar with that technology. I think I'm dating myself quickly, but I would end up looking like a coal miner at the end of most of those days. But I look back and was incredibly blessed because I got to see every single presentation that I was building and shipping out of there for every single of the most sophisticated strategies. And I just learned and read and dug and asked questions. So I actually consider my time on Wall Street as incredibly fortunate. And I was, through the grace of God, a little persistence, and a lot of luck, able to finally convince that manager that I could get out of the mailroom and eventually earn the trust to start actually managing money for folks, which that's started that path. And 8 years later, I guess in 2006, I just had continued to pull on a couple of threads, Adam, and the most, the inside the belly of the beast, with plenty done wrong. There was actually a lot done right and to learn from if you are curious, as I was. And the couple of threads I kept pulling from that complex, sophisticated ball of funds and fund of funds and alternative assets and all sorts of dizzying array of products was, I think this needs to be simpler. And I think a couple of ingredients, if we turn all of this upside down, I had to start with myself. So I escaped. When I say graduated, I left and started our own firm based on the couple of pages of the playbook that I had learned stand the test of time
That's fascinating.
and left everything else behind.
Yeah, it's fascinating, Ryan, because those threads that you tugged at, I tugged in my parallel universe, and not knowing each other up until just recently when we spoke before the interview. It's a very, very similar path, except for the fact that I didn't end up in a big Wall Street firm, nor did I work in the mailroom and work my way up. So the fact that you did that, hats off to you. It's fantastic. I did apply there, but I was told no. Almost every Wall Street firm actually out there. But it's curious to me, those threads that you learned along the way. So you're in the mailroom at a young age. You knew you wanted to go work on Wall Street, so to speak. I noticed as you're describing your story, you speak as if you were working on Wall Street, but you're no longer working on Wall Street. And I find that very interesting.
Well, I mean, it was at the time largest global bank brokerage. I affectionately call Wall Street, and my business partner did work on the actual street named Wall in New York. And so when I say left, we started our own RIA in Houston with nothing. And in 2006, just before the rest of the world would learn about some of the conflicts of interest that we were a little worried about, we voted with our feet and opened with nothing but trust and faith, and offered anybody who wanted us to manage their money the same way we do our own. And even that was the key ingredients were not complex. There was no attorneys, there was no accountants, there was no valuation experts. He and I were sitting at an IHOP that I hadn't been to before, and I haven't been to since, but I knew it was extremely well lit when I drove by at like 5 a.m. So we hatched everything right there and have never looked back. And it's one of the lessons as a business owner that I look back fondly to, whether by accident or the underlying trust, that the lack of complexity there is key too. And I think it helps with trust, not only inside these walls, but then what we're able to share outside them.
No, that's fantastic. So just to recap, you started off at a big firm. They said no. You went back relentless and said, I want to get a job anywhere. They hired you in the mailroom. You quickly realized that it was a sales job, meaning they're out there to promote products, and it's very convoluted and complex. So as you were stuck in the mailroom, you would see all of the presentations that would go out from all of the brokers that worked at the firm. You'd read them and study them. And then, of course, you'd talk to people in lunch breaks or whenever you're schmoozing and just, pick their brains, look for those threads of wisdom. And then you eventually made your way onto the sales side of it, into the money management side, and built a book that way, and then left, and then with zero and started again.
Yep. I mean, they called it a variety of different names that changed: consultant, advisor. I respected the ones who did that exceptionally well. But I did not play golf. I did not have a network. I did not know how to be an asset gatherer. So I wanted to be a portfolio manager. And so there was maybe 60 or so advisors or groups in that office. And I was the only one that, when I started and when I left, chose to manage all the money in-house. I didn't outsource. We didn't use funds or products of any kind. And not through any sort of again, wizardry or arrogance or thinking I'm better. It's just, I always thought that's what this was supposed to be about. And I think the authentic, simple ingredients stand the test of time for a reason. And along the way, and what I look back at, what I took from it that I learned, and is really, I've evolved and changed my thinking even a little bit, is there's a bigger question than portfolio management and what you use and how you do it. As successful as we were thankfully ever able to do that, there's a bigger question. And the complexity I kept coming back to when I pulled these couple of threads when we left and started this, I think the people that we serve had two questions, and we complicated the rest with all of this high-level analysis and complex solutions. And really, the people that I enjoy serving the most are the ones that humbly at some point want to know, am I going to be okay? And how much is enough?
Oh, wow. That's
and
great.
Those are the two questions. We've complicated it with a dozen more in our industry, and we've complicated and confused a generation of investors. So really the planning aspect on top of the portfolio management, and answering those two questions are what has set and been our life's mission since then.
That's fantastic. And that leads me to a perfect segue to my next question. Can you just explain your investment strategy to us, please?
Yeah, so it started humbly with turning almost everything we had learned inside Wall Street upside down. And I mean that, and I use affectionately the acronym that most folks know in industries and trillions of dollars are chasing, which is different versions of R.O.I.
Right.
We're internally focused in the investment industry on ROI, and we have trained investors to believe that's what they are supposed to be chasing. And again, I think this is less, do we do it actively or passively, or which fund or which advisor? I would submit turning that entire process upside down. So I actually think we should start with I.O.R. And to me, future streams of income, which is my I, eventually matter more than any average rate of return.
So wait a minute. Sorry, Ryan, jump in for a second. ROI, just to make sure I'm following the audience as well. ROI tends to stand for return on investment. I.O.R, are you saying income on return, or are you saying investment on return?
Well, it's just a polite wink at me leaving the ROI world and average rate of return and trying to chase returns and appreciation. And I'm saying we're going to turn everything upside down, including just let's reframe those three letters entirely.
Okay.
And we turn it upside down and think of I in a whole different way. And what about now or the future forms of mailbox money? Mailbox money and the ability to enjoy being reunited with some of your capital and income generated free cash flow off of that is a lot more important to people than alpha, alternatives, sortinos, and all that stuff. They just don't know how to ask it.
Right.
And they think that it might be something that they're not supposed to ask, or it's not smart enough to ask. And I would submit the smartest, healthiest, happiest people out there in any endeavor, not just investing, have some version of mailbox money that they can count on in their life. So I'm suggesting some version of mailbox money from whatever source that is before we take risk. I would call O, the opportunity. Before we take any risk to go grow and appreciate assets. And then on top of that, if we got I, income, O, opportunity, the R at the very top to me is, if we turn this upside down properly, is reminding ourselves, or maybe even unlocking, what is the reason? The R is the reason to do this at all. And that answer is very, very different for a lot of folks. So the idea that we're all shoved into these investment products or strategies without answering that question first leads to a lot of very poor outcomes or risk that isn't needed. I mean, I have a client that needs every bit of $700,000 a year to live on, and a plan designed specifically for that outcome. And I have one that lives like a king on $7 a day on the beach. And I'd say, which one is richer? Which one's done it better?
Right.
And they happen to be brothers. So if you don't believe this can be done in different ways,
wow, that's great.
That outcome, that reason of what's really important, why are we doing this at all, does start to ask and answer the questions a lot differently. Not to mention the fact that the ROI chase, the average rate of return chase of some sort, whether you say you're conservative or aggressive, you slide it up and down. Maybe we project 7%, or if you're aggressive and younger, maybe we project 10%. Those ROI numbers and average rates of return are incredibly misleading to begin with. And that is what I learned going through all of those cycles. I mean, one of my favorite simple numbers inside that giant band of every single one of those presentations that I saw leave that mailroom was expecting some sort of ROI between 7 and 10% for the growth assets.
Right.
And that's a huge band. And I would ask folks, professionals included, how many calendar years has your actual return in the market landed on any one decimal point inside that giant band? And in 118 years, it's only happened 4 times.
Yeah.
And 100% of plans are counting on it.
That's a great point. I had another guest on the show, and he said he brought up the exact same point. He said everyone's forecasting or planning as if it's a 10% return or 8%, 7 to 10, whatever it is. And how many times does it actually happen? That's a really good point.
And a lot of time and energy is spent on, is it going to be a good or a bad market going forward? The one that actually sneaks up on us and happens a lot more than we realize, and I would just submit planning is the solution, not predicting, is, Adam, when I got married in 2000, the stock market was lower 13 years later.
Yeah.
Now, if I had been nearing retirement at that time and withdrawing money based on a 7 and 8% average rate of return, I'd be in big trouble.
Right.
And we have long periods of time like that. So I think a solution is, digging some of these wells before you're thirsty and focusing on income before worrying about how much risk to take. And if you tie it all together with a reason, and there's a lot of, intangibles on that side of the question and conversation with your family and who you're doing this for, that tends to put this in the right place that it belongs. And I also think, and I'm a living, breathing example of this, one of my luckiest breaks was that starting from the time I was declined an interview to today, I didn't have a network to fall back on. I didn't have any other hobbies or interests. I think a focus on your craft is the biggest ROI you can ever get, but people are turning that upside down too and thinking investments are supposed to solve or produce or get them there in terms of a retirement or the amount of money, when, especially early on, when we sit down with folks that are nowhere near retirement, focusing on your craft will always be the best return on your own investment. And I think that the idea of living a long life, working long, is actually a goal of mine. Everybody else, it seems like a growing movement in the investment world is to do this real quick and finish early. And this FIRE movement, I just don't get. I think they're skipping the biggest step, which is really finding something you love doing, which has a ton of benefits, not just financially, but health and
mental,
spiritually, and family, and everything else.
Emotional, yeah, of course. No, I love that. So, just to clarify, focus on your craft. You mean whatever your profession is or whatever you do to actually make money, focus on doing that and doing that very well, and let the investments take care of the investments, but don't plan on the investments taking care of you. You take care of you. Is that kind of what you're saying?
Absolutely. And I don't take credit for knowing this. I've learned it. I've watched. I mean, I now have, although, Adam, I've chosen not to age whatsoever. The folks that I serve have shown me, and I now am privileged to manage a couple 3-generation families.
Oh, wow.
And I take really good notes like you do. And I've watched and learned and asked what was the key to their success. And as great as we've done for them, the investment returns are nowhere on that list.
They pale in comparison, right. Yeah, the focusing on the craft is such an understated but so important piece of the puzzle that most people don't even look in that direction. That's a really good point.
Well, it's a purpose, and that, I think there's been a lot of longevity studies proving that is a key ingredient.
Yeah, it really is. That higher purpose or focus on the bigger picture, the greater good. So the investment strategy when just to answer the question for the audience in a clear, concise fashion, would you consider yourself a planner and then an asset allocator, or do you look at undervalued stocks? I mean, how do you put everything together? What's your strategy?
Yep. So we still manage all the accounts in-house. It's never changed. We still are the portfolio manager. My partner and I do all the research and management in-house. So every individual stock and bond that is in our account is what we share and offer to do the same for them. They're all separately managed accounts, no fund. And on top of that, as we've lived and learned and gotten better at our craft, we've just uncovered so many planning topics and considerations and discussions that are so much more important than which way the market's going to go this year. And income and that mailbox money is primary on that list. And it seems like what is most different, I guess. I mean, one of the first questions that we ask that we've very rarely, even from some very sophisticated investors, got the correct answer on when we ask is how much risk are you taking right now? Mm-hmm. And then we pop the hood and analyze the real answer to that question. It's typically nowhere near what they think. And then two, where are your sources of free cash flow going to be coming from, and can you count on them? And then if you do decide to retire, do you have the ability to get a raise in retirement? Those are a couple of basic questions that lead to a lot of deep planning discussions that need to be asked more.
Yeah,
so for us, it's not about allocating and sending it out the door. It's about doing it all in-house with them as partners and guides.
So more of a fundamental value kind of approach when you look at the stocks that you're investing in, when you do your research.
Absolutely. I mean, we and now the quantitative nerdy try to figure this all out guy is still in there.
Bring it on. Bring him out. Let's play.
So I ask a lot of questions still, just like I did when I was trying to get out of the mailroom. I'll ask my now 5 kids at the dinner table if they can name one business that will still be in the same business 10 years from now. Those are some of the best questions I think anybody can ask themselves. And you get a lot of fun answers when you're asking kids, but it's really provocative. And it's one of the first questions I ask myself for all the game-changing technology out there. The game unchangers, as I call them, are actually harder to find and more rewarding over time. And then I want to know, and if I want to keep learning, the most important thing I can do is not just fall in love with those time-tested dividend-paying stocks that can provide that mailbox money for folks, but I want to ask the questions of the market, what's changing without me knowing about it. And rather than pounding my fist on the table and saying, this is our approach, this is our style, which I think tends to be one of the Achilles heels even of the best asset managers, this should not be about me proving or telling anybody how we're going to be right and predicting the market and knowing that our system would work. It's actually doing whatever is necessary to get it right. So we'll ask, and the way I do it is I call them stock tournaments. We'll turn the S&P 1500 upside down and ask just a couple of questions every 2 weeks and see what the market is telling us. And then we will dive in and do a whole lot of good old-fashioned research, but it helps us do a lot of the heavy lifting. So, I mean, for example, the one you and I were talking about, just because it was a stock that a lot of folks are familiar with when Apple reported their numbers, and any stock that is doing well in any industry, I ask the market who is potentially doing anything close. So the one, and it took all of a couple of minutes to say a stakeholder yield, which is dividend buyback and debt management, along with dividend growth like Apple's and acceleration of that growth with the company's free cash flow and a conservative payout ratio. What other stock is even close? And there wasn't a single dividend aristocrat that made it through that tournament, which highlights a little bit of the difference in our approach of just accepting and even tried and true and extremely successful strategies like the aristocrats. Some of that, Wall Street has taught me, is in name only, and they're going to cling to those titles, and they might only be growing at 1% just to keep their record intact. And underneath the hood, they may not be generating free cash flow to pay future dividend growth like that. So we'll ask questions like that, because a lot of times companies change and internally, and they become cash generators. And I think these cues are all around us. I mean, when I go, one of the first books I read when I was a kid is Peter Lynch following his daughters to the mall.
Yeah, One Up on Wall Street. Yeah, it was a great book.
There's still a little bit of that, believe it or not, left out there. And while some people think the malls are dead and you can't even go to do that research anymore, if you have 5 kids and you live in Houston, I can't even find a parking spot in or near the mall. So some of them are doing just fine. And one I happened to notice a week ago was on one aisle was 5 shoe stores, which is what she needed that day. And as a gut punch, as a dad paying for the shoes she finally picked out, I was in awe as a portfolio manager. And that experience made me run right back to the lab and say, okay, who in the world is able to generate this kind of gross profit margin compared to its peers with the return on equity and free cash flow? The S&P 1500 becomes 4 in 1 minute, and then I dig in. So that's where we start on the stock research side.
I love that. So just to make sure I can recap properly. Okay, great. So just to make sure I understand, if I understand your process, you have what you call stock tournaments. So you filter out the stocks in the market, the 1500 in the S&P, or however you want to, narrow it down to a universe of investable securities. And then you look for questions. Some you look for the game unchangers. In other words, what stocks are going to be around in the same spot 10 to 50 years, 20 years, 30 years from now that aren't going to be disrupted, if you will. You want to see what's changing in the market without you knowing about it. So always look for the blind spots like Ray Dalio talks about. And then you look at the leaders or the aristocrats in your parlance, and then you ask what other companies are doing anything close. And then you dig down even deeper and look for dividend growth, free cash flow, gross profit margin, return on equity, free cash flow, et cetera, et cetera. Is that a correct synopsis of what you just explained?
Yeah, it's a different ways of competing to get our attention to do more work. And then any finalist from any one of those tournaments will get dumped into what I call my WAR stock ranking system, which is my affectionate term and love of baseball. My very first job was in the back of a baseball card shop, which is when I learned math and numbers and how to find rosters and better averages than the league. And I was fascinated with that. I also learned about hometown and recency bias when you went on the other side of that desk and who was buying what and where. So the first trading desk I ever opened was actually in the back of that windowless shop and buying cards for 5 cents that local folks thought they knew and selling them to them for 10 cents. But I digress a little bit.
That's
so that's where the war,
that.
WAR comes from. The baseball nerds will know that's win above replacement. So how does the stock compare to the overall market? And that system, I will score every single stock based on basically 4 broad categories of growth, margins, valuation, and then yield. And in each one of those 4 categories, there's a dozen different metrics I use, none of which is going to produce a magical answer or a perfect stock. It's a way of comparing them against each other. I just had this crazy notion from the beginning that all 1,500 stocks don't deserve my attention equally. And that's just using the S&P as one example.
Right.
But making them compete against each other first. And then even when I do think we have this scoring system and open-minded curiosity to find unusual businesses, the most important criteria and probably what has kept us in business as long as we have and will keep us through the next couple of cycles is sell disciplines. I mean, all the buy disciplines and stock selection criteria aside, I think what people most struggle with, including, and I would submit especially professionals, is our human nature doesn't wire us particularly well to deal with mistakes to begin with. There's many, many books and great podcasts on that. But it's even worse if you may have devoted 4 or 5 or 10 years on the research to admit that you're wrong. So a very, very strict, and one thing that has never changed in our business is adherence to strict sell disciplines. I think is key, and I think it's not talked about enough, and I think it's simple. It's not complex. Again, it's math, and maybe the common theme here is informed simplicity is the holy grail. It's not complexity.
Oh, I love that. Informed simplicity. Maybe that'll be the title for the show today. That's a perfect segue to my next question. But before I get to the risk question, can you explain what the sell discipline or the sell rules you use?
A couple. One, I would never start with more than 1 or 2%, depending on the plan and depending on people's portfolios. Whatever the number is, as long as it's a small number that cannot wreck an entire portfolio or plan. So the starting point is key. And I mention that because the first sell discipline, I think, is a great buy discipline and never, ever adding to a losing position.
Never.
That's our opinion.
Yeah.
A lot of very smart folks that are very successful disagree with that. And they'll say in the mutual fund business or asset management business, the low cost basis wins.
Mm-hmm.
And in that world, competing for ROI and attention, I can't argue with them. And I think there's been phenomenal success stories that will continue to pound the table and know that they're eventually going to be right and average down and put more and more risk on the table. I'm not one of those. I think when you're in a hole, you stop digging. So a defined principle to begin with, 0 averaging down, and then third, a predetermined before the buy number. And by number, I mean price. Forget all the fundamentals and forget all the reasons you think you might be right, or I know that I might be right. I set a price, depending on the equity, depending on the market, at a percentage below entry that there are no questions asked. I'm out.
Understood. So I'm going to get to that in 2 things, or a few things are going through my head right now. First thing, as far as a percentage, a stop price, would that be 5 to 10%? Would it be 10 to 20? Just a ballpark of what you would use.
It's not going to be 5 to 10. It's going to depend on the market and the volatility just a bit by name, but 15 to 20 is a good place to start. And then I think it has to be managed. I want to let winners get a much, much bigger band. And at some point, I want to take 100% of the principal off the table after a double and a triple. And that's how you end up with 500, 1,000, and many more percent gainers. I mean, that's the key is eventually finding some 5 and 10 plus baggers and small position size with strict sell disciplines. The winners will take care of themselves, and we'll just never have a big loser. And I think that is one thing I would encourage. And you don't have to have a professional do this. You
Right.
can do the simple back of the envelope math yourself, and whatever your answer is for when your head hits the pillow number. But often it's messed up before you get there because too much of the position sizing is a big part of the problem, not just the sell discipline. So both those, if you take care of that, you get a lot of peace of mind, and all of a sudden you start seeing more opportunities, which is the big beauty of discipline to begin with.
Yeah, that
in my opinion.
It's a great point. It's a really, really good point. So just other questions I have for you, Ryan. It's interesting to me that you focused on price based on your sell discipline, but when it comes to the buy side of the equation, you look for fundamental criteria opposed to price or technical criteria. Is that a correct understanding of how you explained it earlier with the stock tournaments, or do you look at price as well?
No, price. I mean, valuation, as I mentioned, one of the 4 categories that we score by. Absolutely interested in the great entry point, and valuation and technical analysis and momentum and all of that happens to be a factor. Now, I will candidly say, and humbly, and I look back in 24 years of doing this, if you get the business, and I mean this private and public markets, if you get the idea and the business right, price tends not to matter nearly as much over a long term as people think, but short term, it absolutely is a factor.
So, okay, I didn't realize you used technicals for entries. I thought you were just using fundamentals. I didn't get that.
Well, yep. Well, and I try not to bore you and nerd out too much, but once we rank these stocks and score them, actually, so the finalists that would make to consideration, their final exam is we will put a roster, let's call it the minor leagues, ready to compete for one of our precious roster spots. And I will set an alert for every single one of them above and below the market where it is now, where it would be, in my opinion, a perfect time to consider them. I want them competing for the last spot on our bench. If my roster of 50 companies at any point in time, I don't love them all the same.
Right.
And 49 or 50 are ready, I hope, to get beat out. So those entry points and that price, and that part where timing does matter. Short term, I do believe, and I'm just saying long term, that tends not to be a giant factor. Getting the perfect entry price is not the key, but it is a way, again, to further sort through a market of different questions.
So yeah, that makes perfect sense. So now, just for the technicians out there, because I know a big part of the audience like looking at charts and buying breakouts and volume, and they're curious about how to do it. Do you pay attention to the classic breakouts and has to have above average volume upon entry and buy breakouts, or do you just look at other entry points, whether it's off of support or off of moving averages or trend lines, or if you speak to that a little bit, please.
Yeah, my partner from New York is a classic. Of the two of us, a more classic technical analyst, and there's a lot of good reasons you want to be in good marriages at home and in the office. So I use his eye at kind of the finish line there, but in general, I would say, once again, a lot of those are not, since we're not actively trading, it's just a very final tiebreaker, I suppose. But I do think it's worth noting. And in general, the way I would answer your question is strength leads to strength and weakness leads to weakness.
Right.
And I do think that's wildly underestimated. And I think fundamental analysts don't pay nearly enough respect to those forces of nature and buying and selling pressure. So in general, I do think that's an important factor.
No, that's a fascinating point.
And I would say there's some great quote by one of the technical analysts at Smith Barney, and I apologize to him or her that I'll butcher it a little bit, but to any individual listening to this, I would encourage them, and again, to try to demystify this and make it more accessible to more people that don't always have to hire guys like us. He said something to the order of a 10-cent ruler has made me millions of dollars, meaning just
Understood.
draw a simple line or two.
That's fantastic. I love that. Go ahead. Sorry, go ahead. By all means.
Well, that was it. That's as far as I could go at technical analysis before I get somebody angry and somebody that knows a lot more about it than I do.
Yeah, no, just 10-cent ruler, meaning print out a chart and get a ruler and just draw lines. And if you can draw lines, and stock goes above it or below it, then you know to get in or get out. I mean, that's kind of the.
And I guess one point I would add right there that I think I don't hear enough about, speaking of the 10-cent ruler and a simple line, don't hesitate to use buy stops too. When I think there's 4 stocks that I want to buy, I'm more likely to initiate the position at a higher level than a lower one. I'm not eager in trying to get the greatest bottom in a stock. I want the market to confirm I'm right, and that's just one more piece of the puzzle. So I like alerts above the market as much as I do sell the ones below them.
No, that's fantastic. And just to help educate the audience, a buy stop would mean the price, let's say, is at 100, and you'd put a buy stop to go long at 105, for example. And then a sell stop would be, let's say you want to get out at 15% below there, would be $85. So if it goes down to 85, you would get out, assuming, or I guess 15% below 105, whatever that comes out to, 87 or 89. And then you go from there. Is that kind of correct as far as a buy stop and sell stop?
Exactly right.
Yeah. So, okay, fantastic. So the next question for you, because again, on the technical side, most of the fundamental guys I have on the show don't talk technicals at all. And that's kind of why I'm a little bit curious here, and allow me to indulge if you don't mind. So with respect to risk management, what are some mistakes? How do you handle risk, number one? And then what are some mistakes you see people make with respect to risk management?
Well, I do this a little differently. And I'm going to say before we even could have any of these discussions inside the market, we have learned, and again, we're not around here managing 3 generations if we didn't answer this question before we ever put a penny into the stock market. So Our version of how to handle risk is making sure that you have probably more than you were ready for or that you thought possible completely removed from harm's way to begin with, which allows us and the stock market to work with a very different kind of money. So, as you and I have joked about, whether it be raising kids and why they got to eat broccoli before chocolate cake, that's why I think bonds at any interest rate make sense for me. And we have a whole lot of beautifully boring, risk-free, tax-free, ideally, if not in a retirement account, municipal bonds, and we don't try to get the last little bit of yield or try some exotic fund with enhanced strategies. We buy the actual bond, the highest quality, no revenue bond risk, put them in account, no different than I've told this, or I've asked the same question to a 10-year-old as I have to a 100-year-old if they meet us and ask, where should I start? And that is, I bank myself. I follow the first $1,000 that my kid puts in the bank and ask, where does it go?
Right.
Well, a large portion of it has to go in risk-free reserves. And whatever's left, you can achieve a higher rate of return. But having cash and risk-free bonds allows all these other questions the time they need. So risk management, to me, begins before the stock market even enters the picture.
That's a great way to answer the question. And then what about the actual market? Once you identify how much money is going to be invested, do you do it based on, I know you said sell stops. Do you have trailing stops? As the stock appreciates, you raise your stops? I know you like to give your winners room to run. Or do you look at an overall portfolio and see what your portfolio risk is and then adjust accordingly? Or both?
Within the stock portfolio, every position is treated separately, so they all have their own individual stops. There's never a period of time where we have the market stopped, or once again, with a devotion to just getting this right rather than being right. We have never once said we like the market or don't like the market, and at a certain level or a certain political twist or turn, we're out or we're reducing our risk. If you've got enough completely removed from harm's way to begin with, you don't have to worry about that. So our only stops are when we're wrong about an individual position, not the market.
Oh, that's a great point. So, okay, that's really a good point. So the next question I have for you, what are some mistakes you see people make with respect to risk management, in addition to the first one that you outlined, where they don't even focus on the cash and the bonds and how much money is actually invested? What actually with the trading itself?
Yeah, I think, again, if you take a couple of steps back, there's a lot of internal and specific risks that get a lot more articles and books and interviews, and probably why I'm not the most ideal guest, rather than focus on any one of those much more exciting or risky, thrilling pieces of the puzzle. I say if you take a couple steps back, and one of my favorite examples I like to use is we did a blog post on Steph Curry, believe it or not.
Wow.
Because I asked my son, who, like a lot of families, you probably have one kid or grandkid that would love to shoot like Curry.
Right.
And I asked the same question, how many of those families have a plan of any sort? And I mean, it can be on a pencil with one page.
Right.
What I went on a very, very fun deep dive, because I happen to be a hoop junkie on the side also, is the biggest mistake I think people make is thinking that planning is somehow limiting and that planning is boring or that planning will reduce the upside, when I have found, and Curry is just a real fun example, it's not his shooting that is the magic. It's his ball handling and the rigorous, crazy discipline drills he did on his handle that allowed him literally, and there's some really cool data science in this blog post where he's actually able to look at his target just a little bit longer than most shooters.
Oh, wow.
And then he adds even an extra unfair advantage, if you've seen his arc, of he actually allows more time, which has a whole lot of great geometry behind it on entering the rim and the backspin. It descends, and everybody who calls things like shooter's roll and think this is all about luck, and far too many people think about that in the market too. He's actually completely changed the success rate of going in the cylinder, but it all started way before the shot. So my thought would be most folks wait to plan until they have what they think might be enough money to worry about. And I think the creativity and the upside to get there even earlier with more enjoyment actually comes from discipline and planning.
Right.
So I think that's the biggest mistake, waiting on planning and thinking that planning is somehow boring or limiting.
That's a really good point. So when other people talk about planning, they adjust the plan frequently. Do you do that as well, where you sit down with the client and adjust every few years or every few quarters, or is it just once and then forget it?
After we get the initial shock and awe of telling them that the plan will go to 100 plus years, no matter what they say or think about that, we just put that amount of stress test on ourselves and the numbers. If you can see and know that you have multiple streams of income until one of the two of you is past 100, it makes for a lot different progress reports. It makes for a lot different trajectory and different changes. We only would make a change at what we define as a progress review. And even if we talk and all sorts of things are going on in between years, we would never make an allocation change until that progress review as another form of discipline. But it's all revolving around what kind of free cash flow they need and it can produce, not on a prediction.
Interesting. That's very, very interesting. So you're basically going 100 years out, and then that itself shocks and awes the prospect of the client sitting in front of you. And then once they get their head around what you just told them, then you can adjust accordingly depending on their cash flow.
And surprises at that point are to the upside. Even the most conservative withdrawal rates, I think, are going to be in severe jeopardy. If I had to make a guess, although no plans are, as I just said, we're not making any predictions. I think what might be most wrong about the most plans that are out there, and there's very few of them, and less than a third of advisors even have their own plans. So even among those that are doing this really, really well, I think you got to question the withdrawal rates based on interest rates and future returns. Just be careful. And there's a lot of very smart folks, and some are on the radio, and some have written books about being able to take 5, 6, 7% out of a portfolio because it should average 8.5% per year. But those of us who have lived through
right
even just a couple of years,
exactly.
Like the stock market going up 86%, down 39%, down 21%, which is 1999, 2001 in the NASDAQ, the average rate of return says you made 8.7%. And in those 3 years, if you lived through the actual math with $1, you ended up with less than you started. And that's without the withdrawal math. So the average rates of return are incredibly misleading for planning purposes.
Oh, that's a good point. And I know earlier we spoke about you're big on math. And before I go to my next question about advice and mistakes, and before you even continue, I just like to jump in for a second. As you explain your story, Ryan, it just almost jumps out at me every time how you're looking at things differently, whether you began with the R.O.I, I.O.R, every step of the way. Start with the plan, go 100 years out. All this is I love it, and it's fantastic. And thank you for taking the time and actually diving in and explaining it. What have you realized, or what have you learned along the years, those threads of wisdom, if you will, when it comes to math, markets, and money?
That hang in there is not a plan.
That's awesome.
And whether it be from the average rate of return to produce a withdrawal rate to the mountain of conflicts of interest. And if you really think about even all the folks that have said that the fee-only advisors and removing Wall Street's conflict of interest, and there's some wonderful now independent advisors, their entire model is based on hanging in there. And I think you can now question that as the next conflict, right? The mountain of assets and the mountain charts and the projections that everybody shows, and the ones that, even the ones that are accurate, are based on an inherent conflict that they need all of your assets to hang in there for their mountain of assets.
Right.
I would suggest hanging in there is not always the right answer, and a focus on math and the free cash flow and being reunited with your own money is where this all should start.
That's fantastic. So not only do you look at the company's free cash flow, but you look at the individual's cash flow and pretty much build a plan based on that, and then you look to allocate accordingly or invest accordingly, rather.
Well, that might be a much easier and quicker, and probably why you're the professional talker, not me, way of summarizing all this. Even the most sophisticated and successful investors, they love to point at free cash flow as one of the absolute best variables to measure companies. Why don't investors ask the same of their plans?
Right.
We should focus on our own free cash flow, which I just affectionately call, for my clients who coined it, the mailbox money. As he said, I've outsourced almost everything else. Ryan, the one thing I will never outsource is walking to my mailbox and collecting my dividend checks.
Nice. Yeah, he wants to do it himself. Yeah, it makes perfect sense.
There are some things that have stood the test of time.
Right. So, okay, on to the next question. So, what are some timeless advice that you'd like to share with the audience?
Okay.
That you haven't already touched on it. Let me throw that in there.
I guess my best, since there are a few want-to-be traders out there that are probably terribly disappointed having made it this far with this boring old planner, I would say my best trading advice that I have learned is expectations for appreciation. And I mean that at home as a dad and a husband, to the markets, looking through a different lens, and something I am personally working on. And it can be transformative, and a whole lot of things we do every day is trading expectations for more appreciation. And just my own, I'm not a meditation expert. I have no idea what I'm talking about, but my own 10-cent version is, breathing in more joy and breathing out gratitude and sharing and serving as many people as possible is what I'd like the next stage of my career, professionally and personally, to be about. My favorite advice through a proverb is, if you want to go quickly, go alone. If you want to go far, go together.
Yeah,
and that
great.
is currently and will continue to shape me, I hope, in more and more that I do, and I believe it.
I feel it and I believe it as well. And part of what I'm doing here with the whole podcast is trying to get those threads of wisdom, to use your words, and share with the audience timeless information that will be good in 50 years or 100 years or 5,000 years for that matter. And I smell what you're cooking. Let's put it that way.
Well, it was one of the things, and it's a perfect place to end where we started. Of you and I didn't know each other, and one thing that I thought was I had to reprogram myself from Wall Street, where everybody's competition and including internally.
Right.
The idea of the kindness of strangers and what we can learn from each other and share, it is so wonderful. And if you haven't experienced that and you don't believe it, just try it, because some of those same longevity studies on purpose, I look forward to two guys that hadn't met each other like me and you learning from each other going forward, because in the end, what those clients that are the furthest down the road would tell those on their way back is that relationships matter more than all of this. And all the numbers aside, I think whoever ends up with the most memories and good relationships in their bank wins this game. So I want to make sure we make our deposits accordingly.
Yeah, that's a really, really good point too. And I come from that same world of like, at first it was, no, you can't trust anybody. They're all out to get you. Negative, negative, negative. And that's what I was taught as a kid. And I grew up in that kind of a world. And then I looked around as an adult, so to speak, and I'm like, wait a minute, this makes no sense at all. I did the exact opposite. It's amazing how far you can go. And having you here today is just case in point. So I greatly appreciate the everything you're sharing. So thank you very much for that.
Well, it's my privilege, and I've enjoyed listening to your stuff and your guests as well. So thrilled to be on.
I greatly appreciate it. So next question for you, Ryan. Common investing mistakes. What do you see people do wrong besides not making a plan, everything else that you mentioned? Anything else that you can share?
You know what? Can you stop for a second?
Yeah. And we're back from the break. Ryan, thank you very much. I know this is a lot of time, so thank you very much for sharing and being here. Just
hey, I apologize. I apologize. I had to say stop, but my only personal self-discipline on any interview or anything is family comes first. So I had one of my kids interrupt, and I apologize. I wanted to grab that real quick. They know I'll always stop anything for them.
Absolutely no problem at all. never a concern whatsoever. Family first is my rule as well. So what are some common investing mistakes or trading mistakes maybe that you'd like to share that you see people make all the time that we haven't already discussed?
I think complexity is the enemy of execution would be the best way I could summarize. We've dealt with some of the most complex situations, but a new all-time indoor record was broken last month with a 487-page statement that we were asked to review by a dear family member and partner's referral that we turned 3 weeks later into a one-page plan.
Wow.
That is not a proprietary recommendation. There is no K&C product or anything in there. It's a suggestion in everybody's own world,
right,
to move closer towards one page than 487.
Yeah, I love that too. I used to say, I can't even use the language on the air of those 500-page reports as intellectual, something that's not a nice word to use. So I fully understand what you're saying here. Big fan of the KISS method as well. Keep it simple. And the last S I always joke around is for me. So I fully get it. And then the final question I have for you, Ryan, what is the best advice you've ever given or received?
Far too many wonderful people and blessings in my life. So just to cheat and to make it timely and the thrill of a live podcast, the interruption that I just received, the advice that I just gave,
nice,
was my daughter, who is, when I started this business, we were brand new family. She was a little bitty kid, and now she's applying for some incredible scholarship at a university that would probably never have made it that far. And my advice to her, and the thing I've tried to live and do professionally and personally, is to dare to be different.
I love it.
And for us, that is both in math and action and careers and faith and family. It ain't easy, but daring unapologetically to be different is the advice I just happened to give. Now, who knows if it'll work or not, but we're going to keep it up.
Fingers are crossed. It's working so far. Well, Ryan, that's absolutely fantastic. Before we wrap up, is there anything I didn't ask that you want to add before we wrap up?
Well, on that same note, and I'll just give a quick wink, one more, that if you throw everything else we discussed out the window and your last interview and your next one and all the next things I'm going to learn, one of my very favorite clients, after I served her for 17 years, said, "Do you know what the most important variable in all of this is?" And of course, I'm sorting through all my brilliant discoveries and remarks and humbling disciplines and all the planning and everything we've been through. And she floored me with her advice that I just got lucky on personally, but She said, the most important part of any plan is who you marry.
Nice. That's great.
And at first, I kind of dismissed it in my younger years. And now that I've watched folks and the turns that they take, success, not just with investing, but in their lives, boy, was she right. It has a whole lot to do with everything.
Yeah, and to your earlier point too, it's not just married at home; it's also married in the office or at work as well. So that's
Amen.
really good point. Really, really good point. Well, Ryan, you've done it all. Thank you kindly. This has been a really, it's a great pleasure having you on the show. Before we wrap up, what is the best way for people to get in touch with you?
I enjoy trying to share as much of what we're seeing and doing in a blog that is a polite tip of my cap to the old Wall Street chase for ultra high net worth and R.O.I. to who we actually enjoy serving more. And I call it the secrets of the merely wealthy. And I enjoy sharing their stories and what we're learning, and for nothing in return, just learning and sharing with each other. And that's how folks like me and you meet. So I'm thrilled to do that. They can find it on our website, KrugerCatalano.com.
Beautiful. Well, thank you very much for being on the show, Ryan, and hopefully we'll talk again soon. This has been fantastic.
That's my privilege. Thanks for what you're doing too.
Oh, it's my pleasure. Thank you kindly. We'll talk soon. Bye-bye.